And business news from Pakistan. The country's inflation surged for the second consecutive month in December. Price growth was fueled by a weak currency and the International Monetary Fund-backed increase in energy costs. That stands in stark contrast to an easing in inflation globally. Pakistan's consumer prices rose by 29.66% in December from a year ago. That compared to a reading of 29.23% in November and a median prediction of 29.05% rise in a Bloomberg survey. To put that into context, India's retail inflation is hovering around 5.5% in Pakistan last month. Transport prices jumped 28.6%. Food costs were 27.5% higher. Housing, water, gas and electricity prices rose by 37.68%. The higher than expected reading of Pakistan's inflation is in stark contrast to the State Bank of Pakistan's expectations. Citing easing inflationary pressure, Pakistan's central bank kept their interest rates on hold last month for a fourth straight time before the IMF's nod for a $7 billion loan. But with inflation remaining stubbornly elevated, it spells trouble for Pakistan. What's not helping is a weaker currency. Pakistan's currency fell 20% last year. It ranked among the worst performing in the world, which is driving consumer costs higher. To keep the IMF bailout on track, the authorities have raised taxes and energy bills. This has increased the burden on the consumers. Ahead of the February national elections, the caretaker administration has cut retail fuel prices, reflecting a fall in global oil prices. But a weaker currency is weighing further on import costs. Rising inflation also calls for immediate action from Pakistan to keep their hopes of the IMF bailout in play. The caretaker government and the consumers will once again feel the pressure in the country.